All right, so let's get started into it. I want to remind everybody that you are being recorded. You're mute, or you are muted also, but of course the Q&A is available, and just forget about chat. I can't figure out chat. I can chat some things to you, but you can't necessarily chat to me. So let's just forget about chat and let's use Q&A. But so if you have questions as we go, just ask those questions in the Q&A and I'll address them. So I talked about the slot conference I was at in Las Vegas, and the hits keep coming from that. In fact, there was a piece that I was going to go over today that was put out by Andy Ives, one of the Ed Slott specialists, and I've decided just to put it in an email because it's so much, it would take too much of our time for me to read through it. But it gave a really good wrap up of some of the key issues. And one of the things that I had forgotten about until I read it again was a good program that they did. And I guess it probably took about an hour or more where we went through and we talked about things that IRA mistakes that can be fixed and IRA mistakes that cannot be fixed. So that was a really good piece. So we talked a bit about that. But I'll send it to you via email. It's a nice recap. I hope you joined us last Wednesday with Heather Schreiber. Heather, I think you'll agree, is wonderful, very, very knowledgeable, really the best that I've seen in the Social Security planning space. She knows Social Security inside and out. And in fact, the day after, now I've known Heather for a bit of time. We don't, like I said, we don't know each other. We've never had dinner together or anything like that. But we see each other at the slot events. And I just knew I had to get her on for a webinar. And after that webinar, I was completely convinced that we needed more of Heather Schreiber. So we have Heather on retainer for you folks, for our clients, I should say, our clients only for our firm. So if you have a question specific to Social Security, we'll have a direct line to Heather, and Heather will also going forward help us with our Social Security planning. So I like to have the best and the brightest. So Heather certainly fits that bill. So that's exciting. Today, we're going to talk about in our financial planning section. Well, let me go back. First of all, if you're watching us on YouTube, hit the like, subscribe, and notification button for me, please. And we're going to spend about 15 minutes on slot updates. We're going to talk about the markets a bit. And then we're going to do a financial planning update, the same method that we follow every week. And this week's planning update is what happens when I'm suddenly single in retirement. Now we're talking about if you're over, if really you're in retirement or coming close to retirement, and you don't have dependents in the house. So if you have dependents in the house, the rules are a little different for you. But we're talking about a married couple, and suddenly one person passes. And I talk about this today because I'm surprised sometimes that people forget this, right? So we go into retirement together, hopefully, and at some point, one of us is going to pass before the other. That's usually just how it happens. Very rarely do you see a couple that pass, within the same year, or I guess as you get much older, that happens. So yesterday was I think the 4th anniversary of my mother's passing. So she was 90, and then my stepfather passed within the year. But really, we're talking about if you're in your 60s, 70s, 80s, and what happens really when, from a tax point of view, when you're suddenly single. All right, so let's catch up on some headlines before we get into it. So the Wall Street Journal, I was looking over it yesterday or today. And they were talking about the Fed looks to raise interest rates another 0.75 percentage points. So this is interesting. And they go on to talk about the central banks inflation and their thoughts about the continued raising of interest rates of the European Central Bank. So the ECB raises key interest rate from 1.5% or to 1.5% from 0.75%. Just this past Thursday, again, as anti-inflation campaign that they have, part of that. Their CPI, Consumer Price Index, for October was up 10.7%, not the US, but the European Central Bank. So big concerns. I know we had a bit of a run in October. It was a good month for the overall markets. I think the number was about 8%, up over 8% for the markets. But I don't want to be pessimistic, but I don't think the worst is behind us yet. So I think that as the Wall Street Journal is reporting, and you'll hear later, BlackRock is reporting or assuming as well that our own Fed is also still concerned about inflation. We're looking at another 0.75% increase. All right, we talked about Social Security cost of living allowance last week, but I'll keep it here. I'll mention it again. 8.7% is what's set for 2023. So this came up during the Slott conference, and it came up on the Social Security webinar that we had last week. So I'll mention it again. Somewhat, and it's interesting to me. We had about 300 people who attended the conference, and these are some of the best and brightest in the country. But there was a question from one of the advisors, and I think I had said it Wednesday. I hope he or she, it was a he. Hope he is new to the program, but he said, why would I wait to collect my Social Security to get an 8% increase when I can collect it now at 62? And or at full retirement age, even anytime before 70, and get 8.7%. Well, the fact of the matter is, if you're you get both. If you're in the Social Security claiming parameters, you get both. If it's prior to that, you don't. But it's built in. But it's so really, when I was talking to Heather about this last week, I said, really, I'm sure the math isn't as direct as this, but it's a 16.7% increase if you're full retirement age and you delay it another year. So if you're in that corridor, you do still get the COLA increase in addition to the 2/3 of 1% every month, which is 8%. Increase for Social Security. So again, I know it's confusing. There are not many things that are more confusing in planning than required minimum distributions, especially inherited required minimum distributions, or required minimum distributions for an inherited IRA, and Social Security planning. So I get it that it's complicated, but that's why we have folks like Heather on our team. Okay. So let's talk today about our slot updates. I'm going to just move our picture. I'm going to share our screen. Larry, I see you have your hand raised. If you have a question, go ahead and type it in the Q&A, and I'm going to lower your hand. Maybe it's just there from when you had you were telling me you could see me and hear me okay, but I've lowered it. If you have a question, just type it in the Q&A. So let me share my screen here. We got a full house today. All right, so this is the Slott mailbag. So of course, this is when people write in with questions. I thought there were a couple good ones here. So we'll go through it. I'm just gonna make this a little larger and you can follow along with me. So this is Andy Ives. He's one of the Slott technicians or specialists. So the question that came into the Slott group was, whoops, I turn 72 next month. Can I take part of my RMD this year and the balance before April of next year? So remember, in the first year that you're required to take required minimum distributions, actually your required beginning date isn't until April 1st of the year following the year that you turn now 72. So you turn 72 in 2022, for example, you technically don't have to take that required minimum distribution until April 1st of 2023. Now, what Howard is asking is, well, wait a minute, can I take part of it this year and part of it next year? So let's see what the answer is. Andy writes, happy early birthday. Since you turned 72 this year, 2022 is your first year for taking a required minimum distribution. With the first RMD, you have until April 1st of the year after the year you turn 72 to take all or part of the first RMD. So if you want to take part of your 2022 RMD this year and the balance by April 1st, 2023, you're welcome to do so. Just remember that you will have to take your 2023 RMD and all future RMDs by December 31st. So you only get that delayed distribution option that first year. Every other year, it has to be done by December 31st. And what's the big deal with these RMDs? Well, the big deal is if you don't take your required minimum distribution, the penalty is 50%, 50% of what you should have taken. So it's a big deal. They have to be taken. Now, remember, This is for traditional IRAs. Roth IRAs, your own Roth IRAs, do not have any RMDs. So you can keep that money in there as long as you'd like. You can take as much or as little as you'd like every year from your RMDs. And as long as they're qualified distributions, they are tax-free. Now, Roth 401ks do have required minimum distributions. They don't, you don't pay tax on those distributions, but it's the retirement plans and IRAs have different rules. Remember that. And you must take distributions out of your Roth 401ks. If you don't want the distribution, an easy answer might be, it might make sense to roll it into a Roth IRA. And that is the, leads into the next question. So the next question, this person writes, his name is Roger. Dear Roth IRA experts, I have a Roth IRA question and seeking your expertise. My question has to do with the IRA 5-year rule. I am over age 59 and a half. I have a Roth IRA created with Roth contributions started in 2015. So it's 2022. So Roger, now being over 59 and a half, he's already passed the requirements for the 5-year rule. Remember, the 5-year rule is very complicated. Under 59 and a half, it gets very, very simple over 59 and a half. When you're over 59 and a half, as long as you've had a Roth IRA, any amount in any, even if you have 5 different ones or just one, and you want to add another separate Roth IRA, and even if you only have $100 in a Roth IRA that's more than 5 years old, you've met the requirements. So really simple to cover your bases once you're over 59 and a half. Under 59 and a half, they each have their own starting clock. It's really confusing, but don't worry about it over 59 and a half. I shouldn't say don't worry about it. It's much, much easier to keep up with it. Okay, this Roth IRA meets the 5-year rule, he said. I have a Roth 401k created by converting pre-tax funds to a Roth IRA annually, which was started in 2018. So 3 years later. I want to roll over my Roth 401k into a second Roth IRA, different custodian, doesn't matter. Will the withdrawals from a newly established second Roth IRA principal and earnings be tax and penalty free? So a little confusing there, but he now says, I have a Roth 401k that's not quite met the 5-year rule. What happens when I roll it into a Roth IRA, even at a different custodian? So the custodian means the place it's held. So we custody with Schwab and TD Ameritrade. Let's just say Roger does Fidelity and Vanguard. He has one Roth IRA at Fidelity, and now he wants to open another one at Vanguard. He says, okay, but now what does that 2018 carry to the new custodian? Do I have to wait another year before I get tax and penalty free withdrawals on the earnings? Let's see the answer. So Andy writes, Roger, even though you are just a couple months short of meeting the 5-year clock on your Roth 401k, you will have full access to all Roth IRA dollars after the rollover. I'm showing some of my notes. I don't want to confuse you. So I'm here. If you roll the Roth 401k to a, I'm sorry, where am I? If you roll the Roth 401k to a brand new Roth IRA before the end of 22, those former plan dollars will maintain the same character as they were in the plan conversions and earnings when they go into the Roth IRA. However, they will adopt the clock of your existing Roth IRA. So remember, the existing Roth IRA went back to 2012, I think it was, right? No, 2015, excuse me. So that 5-year clock is already covered. So once he rolls those funds from the 401k, the Roth 401k, into the Roth IRA, it picks up the clock of the Roth IRA. Since you started your first Roth IRA in 2015, no, it said it there, that start date will apply to all your Roth IRAs, regardless of how many you have and regardless of where they're held. Since you already met the 5-year clock on your first Roth IRA and are 59 and a half or older, you have immediate access to all Roth IRA contributions, conversions, and earnings tax-free. Hallelujah. It might behoove you to wait until January before doing the rollover. This way, it will be a qualified distribution from the plan, and you can avoid any possible confusion of sorting out what the plan conversion dollars and what was earnings. So interesting. Again, this stuff is very complicated. I understand that even sometimes it's hard to follow. I hope I make it a little simpler for you. And I hope just by repetition, it kind of embeds in your heads a bit. So moving on here, let's talk about the markets. So last week, the S&P 500 was up nearly 4%. The Dow Jones Industrial Average was up 5.7%. The NASDAQ was up 2.25%. The Russell 2000, that's smaller companies, US companies, was up 6.02%. Foreign stocks up 4.14%, and emerging markets, so that's smaller economies, was down 2.24%. So that's all good. It's all green for the week, except for emerging markets. With stocks. Year to date, though, the S&P 500 is still down 17.1. The Dow Jones Industrial Average is down 8.1. It's come back a lot, folks. It's good, but it's still we're still showing red for the year to date. NASDAQ is down 28.6. The Russell 2000 is down 16.9. Foreign stocks are down 22.9%. Let's call it 23. And emerging markets are down nearly 30%. So still a tough year. And as I said, I'm not sure it's over. One of the research portals that I look at a lot, I actually spend a lot of time reading them every morning, is a company called Seeking Alpha. You can access it for free online. I pay a subscription, so I get some more detailed information. But Seeking Alpha referenced BlackRock in one of its reports today. So, and I actually have it in both places under BlackRock and here, but I'll just read it from Seeking Alpha. But we'll start talking, potentially I'll start plugging in some information about Seeking Alpha. But remember, when I mention these things, it's not a recommendation to buy or sell anything. It's just to give you some familiarity of where we are in the markets and to help drive some decision-making points. So Seeking Alpha writes, BlackRock issued a pessimistic view of the impact of the Federal Reserve's hawkish policy, continue to raise rates, will have on the economy, suggesting that the central bank's aggressive campaign to increase interest rates may have already made a recession inevitable. So we've been hearing that a lot in different, really across different wires and different publications. It looks like recession's inevitable going into 2023. You've heard me say, I think when we're looking back, we're actually going to see that this recession started, March of 2020. It was just temporarily held off by the massive outflow of dollars from the US government, which really obviously brought up the markets and kept prices down and things like that. But now we're seeing the snap back of that. I often use the analogy of that rubber band, that when you stretch a rubber band a little bit and let it go, it comes back to you, but doesn't sting. But when you really stretch it far and let it go, it stings. And that's, we were at that stretch, the really high stretch to where it was just about to break. It goes on to talk about the wave of buying on Tuesday morning, but that was from the end of the week last week. But the feeling is that, and again, at least from BlackRock and other analysts, that this Fed tightening is going to continue to press down the economy. They're not going to stop anytime soon or ease off anytime soon. So it's going to be a tough slog. You know how I feel for the next year and a half, 3 years, maybe even 5 years. BlackRock further goes on to say, we see central banks on a path to over tighten policy, their balance sheet reductions up, selling pressure on government bonds. So we're underweight. BlackRock says they're underweight government bonds. We think rates will and may already have hit levels that make recessions foretold, as was reported in Seeking Alpha. That isn't yet reflected in earnings and market pricing in our view. So that's a big deal, what they just said. They're saying that the overall market, believe it or not, has not adjusted to this potential recession next year. So that's interesting when you look at those numbers I just gave you, where we're down, 10%, 20%, 30%. BlackRock is saying they don't believe that that's considered in this recession, and the dampening of the economy is not considered in yet. With the market drops that we've seen, I don't know if I agree with that, but yeah, it'll be yet to be seen, right? Okay, let's see if there's any questions before I move on to our financial planning topic. It's a question. Doug asks, bond funds are worse than stocks at this point. So I'm going to try to answer this without being too specific, Doug. I'm happy to talk to you about this one-on-one. Bond funds are very risky for sure, because bond funds have a perpetual maturity. So they really, you never have the luxury of saying, well, if I hold this bond for a year or 2 years, whatever the maturity date is, then I'll at least get my money back. And we're talking about government bonds. Corporate bonds don't really, I mean, it's got the guarantee of the corporation that you're going to get your money back. But, you know, GM went bankrupt in the Great Recession and the bondholders got about 10 cents to the dollar. So, so we're talking about government bonds. So US government bonds are considered the safest in the world, right? So, well, let's hope that continues. But when you buy an individual bond, you know that you're at least going to get your principal back, even if it's less, even if it's showing that it's worth less along the way. And that could happen because interest rates go up, and your bond that you've got a 1% interest rate on, you can now buy a new one for 2%. So you would have a hard time selling that bond that you're getting a 1% interest rate for in the open market if I could go out and buy a 2% dividend paying, yield paying bond for the same, for the same maturity. So, but bond funds, they have to trade every day and they're priced every day. So that's why you see the value of bond funds fall. So I think the bond funds are the riskiest place to be right now for a couple of different reasons. First of all, I think bond managers have a hard time managing bond portfolios in an interest rate environment. They have to keep a certain amount of cash available because of outflows, and people, when they see values drop, they sell them. And consumers aren't prepared for it. So no matter how much coaching we do, how much talking about this we do, people still think that bonds are the safe alternative. But what people are saying in their 60-40 portfolios or their 70-30 portfolios is that their bond holdings are down 13, 14, 18%. Given the type of bond fund, it could be worse than that. And they're not prepared for that because they don't think that those bonds could lose money. First, they haven't experienced that in over a decade. So everyone's surprised by that. So your question is, are they worse than stocks at this point? It depends. It depends. I think they're riskier than stocks at this point, especially from the position people come to them from. And that is the safe alternative. And I'm doing air quotes if you are just listening. They're not a safe alternative. They help in traditional markets, bonds I'm talking about, help offset the risk of stock, but we're not seeing that to the degree that most people expected during this downturn. And frankly, it was expected as interest rates are going up and the economy is struggling. Good question, Doug. I hope I answered your question. All right, let's go do our financial planning topic. So I'm going to switch over to the whiteboard. Hopefully you'll be able to see. All right, so can you all see my whiteboard at this point? And it says financial planning topic, what happens to my tax rate when I'm suddenly single? Okay, thank you. All right, I'm going to put this down so I can draw on it. So you all know how that is. So I'm looking down at my whiteboard so I can draw on it. All right, so you're all familiar with this, and we talked last week about the changes, the inflation changes in the tax code and the income bands and how they change. But we want to focus today on the difference between married filing jointly and single taxpayers. And again, the reason I brought this up is because it came up in a conversation with someone, and they said, "Oh, I just didn't realize that my taxes go up when one of us dies." And they said, my tax bracket's going to increase. And the tax bracket, of course, doesn't change. Or they said, no, the tax brackets change. Well, technically the tax brackets don't change, because let's focus on these. These are your tax brackets, right? So they stay 10, 12, 22, 24, 32, 35, and 37. But what changes, and let me see if I can erase this. What changes here, sorry. New. Okay, I'm going to leave that there. What changes here are the income levels. So let me make this a little bit bigger. So look at married filing jointly. And let's look at these different tax brackets. So most people live right around here in this section. right? The 22 to 24% bracket. You know, some of you are certainly up here, but most of middle-class America is right here, especially today because of this bracket, right? The 24% takes us all the way up to $340,000 for a married couple in taxable income. And that's the gift of the Tax Cuts and Jobs Act. And I could get into a whole discussion about what happens in 2026. And in fact, I talked about this in May. You know, what happens in 2026 to tax rates, and tax rates change dramatically then. But we're just talking today about the difference between married, filing joint, and single. Now take a look. So here we have $340,000 is the top of the 24% bracket. Well, when your spouse dies, you have 1 calendar year of that. So spouse dies in January, you've got that year where you can still file as a married person. And then the following year, what happens? Well, look at the top of the 24% bracket goes to $170,000. So if the math is really easy, it's half of that, right? So half of $340,000, $100 divided by 2 is $170,050. And that's the same here. $170,150 is the top of the 22% bracket. And that drops in half to the $89,075. So what that means is you have less room, right, in that 22% bracket and 24% bracket. And if that doesn't quite make sense to you, remember, think of it as this graduated cylinder. So let's plot out our tax rates: 10, 12, 22, 24, 32, 35, and 37. Now, I'm just going to pull up my own tax rates over here. Give me a second. I'm just going to my website and pulling up the tax rates. So over here, we're going to do married, filing joint. And over here, we're going to do single. And we're just going to focus on these areas. So remember, I'm going to the top here. The top for married, filing joint is the 22 is 178, 140. So that means if you're spending money, doing Roth conversions, forced distributions from your traditional IRAs, you can go all the way to $178,140 in taxable income before you go into the 24% bracket. And if you're married, you can go all the way up to $340,100 before you cross into the 32% bracket. So that's a lot of travel. That's married, filing jointly. Well, once one of you passes, right, one of you RIPs, then you move over to here. And the top of the 22, remember we just said it, goes to $89,075. So if you were filling up this 22% bracket, going all the way up to $178,000, and you may not have an option, remember required minimum distributions or what you just need to spend during your lifetime, then you're going to reach the 22% bracket much faster, aren't you? There's about a $90,000 difference. So you're going to go into the 24 and pay, you know, at this point, 2% more for any dollar over that $89,075. I'll tell you a secret though, this 28% or 24% bracket becomes 28% in 2026, and these income levels condense even more. So if you want to go to the top of the 24% bracket as a single filer, which again, you're forced to do, you don't have the option, it's $170,050. So you can see where if you're at $178,000, you're filled up all the 22%, you filled up all the 24%, and you're going $8,000, what's that, $90 into the 32%. So you're certainly immediately paying more tax. Now, will your tax rates double? That's a common thing. As soon as you get married or as soon as you lose a spouse, your tax rates double. Probably not. What happens is your income levels cut in half, forcing your income tax up higher. I don't think you're going to see the doubling there. You're going to see the doubling before we know it, just because of the pressures coming out of Washington, but not immediately when you pass or when one of you passes. Now, what's the big deal about this? Again, the big deal is there are some people who look at these down markets. People look at them two different ways. Some people say, okay, this is a great opportunity to consider my Roth conversions. If my stock accounts are down, you saw anywhere 10, 20%, I can move those funds over to a Roth IRA. And when we get the recovery, I'll get the recovery in the Roth. So that's good. That's a good way of looking at it. Some people say, oh my gosh, the markets are down, my accounts are down. I hear about this recession. I'm a little paralyzed by fear. I want to stop doing my Roth conversions this year. Now that, and then that does a couple things. So first of all, it delays the plan. So any year that we delay gets pushed off to later, obviously, and that increases the tax rate risk. So it increases the risk of taxes being higher, and you just by, again, the pressures of the government, but certainly increases the risk that one of you passes away and you're in the single bracket or the single income threshold. See, I did it myself, while you're trying to complete Roth conversions. And you can see the problem, I hope, here, where we can go all the way up to $340,000 in Roth conversions as a married filing joint tax filer. But we're limited to $170,000 of total income, including conversions, to stay at the top of the 24% bracket as a single filer. So my recommendation is, I know it's scary, but if you have a schedule of Roth conversions, stay with it. Don't let the outside pressures concern you. I know it's difficult to pay the tax at times. It's always difficult to pay the tax. Who are we kidding? I don't like paying my quarterly taxes either. I contribute everything into our Roth 401k, and every now and then I get a little itch in my brain saying, geez, I'd like to move some of that. I'd like to just take a deduction, but I know it's better in the future than doing it today. And it's not always easy. And attending these webinars, attending classes, that helps stay on top of this. So I hope that makes sense. Let me see if I've missed anything else. Yeah, Roth conversions are harder than to do when you're single, and you can't, if you've got, listen, if as spouses, let's say spouse number one, spouse one has $1 million in IRAs. Spouse number two has $2 million in IRAs. And you might think, okay, well, it's not so bad, but what happens is, so RMDs in the first year will be about $31,000 here, and obviously about $62,000 here. And people also forget that the typical way that spouses inherit IRAs is spouse number one dies, spouse number two gets that IRA. Now this becomes $3 million, right? That's a 3. And now you've got to add that RMD onto here. So that's $93,000 that you have to take as an RMD. And this, your first year RMD is probably your smallest, because the percentage gets larger every single year that you have to take out. So this could quickly become, $150,000. That's assuming you have some growth in IRAs, which most people do. So again, I hope that's helpful. Stay the course, stay with your Roth conversions and your strategy. If you're fortunate enough to still be married, still have your spouse with you, take advantage of this, because it happens quickly, and I've seen it too often. And we have plenty of people who come to us. We had a series of widows this year, and they would love an opportunity to continue, of course, have their spouse with them, but just from a tax point of view, to have the ability to continue to convert all the way up to $340,000 instead of being limited to $170,000. All right, let me stop my share here. And we've got a couple questions. Oh, Gerard, good. That's a good point. Standard deduction is also cut. Yeah, I forgot about that. So let me bring back my share. So Gerard asked a great question. He said your reliance on standard deduction is also cut in half. So when you're married filing, when you're a single filer, look at your standard deduction here. Your married is 25.9. Oops. 20. I don't know why it's not letting me draw on there. 25.9. Your single is 12.950. So and if you're over 65, you lose an additional 1,400. So this is 1,400 times 2 if you're married and over 65 or blind, or there's some other, I think there's some other conditions, but you lose that and your standard deduction gets reduced to 12,950. Really great point, George. Thank you. So again, the moral of the story is get it done while you can. In the best, if you are married now and able to file as married filing jointly. Doug asked, what is the RMD basis if you move money from traditional IRAs to Roth IRAs the year you turn 72? Let me think that through for a second. What is the RMD basis if you move money from traditional IRAs to Roth IRAs the year you turn 72? So you're talking about Roth conversions. And let me make sure I'm not sharing anymore. Yeah. So you're talking about Roth conversions, and you have to do any RMDs before you do any conversions. So you want to be really careful about that, because if let's just use, $200,000 as an example. If you converted $200,000 in April of 2022, and you turn 72 in April, then, let's call it that. If you turn 72 actually in any time in the year, you have to take a required minimum distribution. You have to take it by April 1st of the following year. And you might think that gets you off the hook for this, but it doesn't. That RMD has to come out first before you do a conversion. So if your RMD is $30,000 and you convert $200,000, but you do that conversion first, you're going to have to make an adjustment. It would, in your conversion amount before the end of the year. So that's number one. So you've got to do your required minimum distributions before any conversions. Number two is basis. The only time you see basis in a traditional IRA is if you have after-tax contributions, and you've got to pay attention to those, and hopefully you've got your filings for that or your documentation for that. But if you convert, let's just say, out of that $100,000 or $200,000, if $100,000 of that is pre-tax, and you convert that, this gets complicated too because there's a pro rata rule. So it could be that $100,000 of that is converted tax-free, right? It just moves from your after-tax portion of your traditional IRA to Roth. But if that's not the entirety of your IRA, if you have $1 million in your IRA and $100,000 of it is after tax, that's going to be only about $10,000 of that conversion is going to be tax-free. The rest of it is going to be considered a regular conversion, and you'll have to pay tax on that. And that's known as the pro rata rule with Roth conversions. And again, a very confusing topic, but I hope I answered your question. All right, folks, it's 10:42. That's going to wrap it up for today. We went over some market discussion. We talked about some slot updates, and we talked about what happens when I'm suddenly single in retirement to my tax rates. I look forward to seeing you all again soon. You'll get a recording of this webinar before the end of the week, and you also will get a recording of last week's webinar with Heather Schreiber in the next couple of days. I expect that video to be done in the next couple of days. And I'll either be calling into you all from this location next week or back at my home office, but I look forward to seeing you all again. Take care. Have a great week.